Welcome everyone, my name is Jason Weaver. I'm the managing partner with Weaver Consulting Group, a local registered investment advisor practice here in Huntington Beach, California. Thank you for joining us for 3 topics from our most recent conference call in 3 minutes. Late cycle, bond quality, and stock quality. Late cycle. So the economic cycle is a natural fluctuation in the economy between periods of expansion and contraction. There's factors that help determine where we're at in the economy. GDP, gross domestic product, interest rates, employment levels, and consumer spending. And as you can see from this economic clock, if you had rising inflation, rising interest rates, and you had very low unemployment, and consumers were spending a fair amount of money, and you would see that through retail sales, you would be probably in the somewhat of the peak part of the economy. We call that late cycle. There's typical sectors that do better than others in late cycle. As you can see from this chart, consumer staples, healthcare, and utilities in the late cycle of December 2007, March 2001, and July of 1990 outperformed consumer discretionary stocks and technology stocks. Bond quality. A bond rating is a grade given to a bond that indicates its credit quality. AAA is the highest rating you can get. Those are usually given to treasury bonds. BBB is the bottom of investment grade. So pay attention. This is the most important time to be paying attention to your actual bonds in your portfolio. If you have bonds that are below BBB, they're called junk bonds. And what's happening in the junk bond market is very important. And what you're seeing here is the difference in yield between a treasury bond and a junk bond. And when yields spike, like here, the price of your bond is actually going down. So that was the recession of 2008. We're starting to notice that yields are starting to spike a little bit here in the last quarter now, the fourth quarter of 2018. So pay attention to your bond funds because they might be losing value when you think they're supposed to be the safe part of your portfolio. Stock quality. Quality is an equity style that describes stocks with more liability and less risk. And generally how we know that is through their profitability, their earnings quality, the financial leverage that they have, asset growth, and corporate governance. Quality stocks generally do better when the economy starts to slow or contract. And you can see from this chart again, expansion is when we're growing at its fastest. Momentum stocks like Amazon or Google do the best. Through slowdowns, minimum volatility and quality stocks do better, which is typically again going to be like Johnson & Johnson, it might be Procter & Gamble, those types of stocks. Contraction, again, is going to be where the economy is slowing, minimum volatility and quality will outperform, and then through recovery, you want more size and value. Thank you again for joining us for 3 and 3.